My name is Antony Bugg-Levine. I'm the CEO of the Nonprofit Finance Fund. Can everyone hear me? So I'm the CEO of the Nonprofit Finance Fund, which is a community development finance institution that makes loans and provides financial advice to organizations around the US and a little bit elsewhere, focused on promoting social justice and other issues. I'm also the chairman of the Global Impact Investing Network, and despite the fact that my wife hates when I say this, a professor at Columbia Business School. Not that she hates Columbia Business School, she just has a PhD and a JD and thinks that I shouldn't be called professor because I teach once in a while. But I'm very excited to be back teaching in a few weeks a course on development and business. So I'm very excited I'm not actually going to read the panel descriptions, the bios of the participants, but just to say that we have a great panel to explore a wide range of issues related to how do we use for-profit investment as one tool to promote more equitable and just communities in the US. That's really the framing question this panel will be talking about. And I know from Professor Farmer's talk and others, there's certainly a lot of interest in issues of social enterprise and how it pertains to international development. There's even a longer history of social enterprise and impact investing being made relevant in US communities. And so what we're going to talk about with the three panelists and another panelist who will be joining us shortly is how the 40-year history of community development finance in the US has made some major advances in our communities, what the challenges have been in that history, what we can learn from it, and importantly, what these panelists and the people they work with see as the most exciting opportunities and innovations for the future. So that's generally the arc of the panel. We're not going to have any formal presentations. There will be no PowerPoints, and I really hope that we're going to have a discussion rather than a set of random speeches, followed by hopefully a set of interesting questions, which we hopefully will have time for at the end. So as I said, their bios are in the book. I'm not going to to sort of read those, but did want to just start by getting a sense in the room. I assume if you're here, you're interested in this idea of community finance and community development. How many of you have worked in this field? Okay, so if I say the words Cdfi, NMTC, and well, let's leave it there. Cdfi and NMTC, how many of you would know what that means? Okay, so we're going to go on the assumption that this will be an acronym-free zone. We will define acronyms. Community Development Finance Institutions and New Markets Tax Credits are two acronyms associated with our field. I will ban the panelists from using them without explaining what they are. And we're going to try and make this relevant both for those of you who are intrigued in this idea and have not worked in the field, as well as for those of you who have had experiences or are more expert. So with that, I just wanted to turn to the panel and begin by asking you to talk a little bit about how the institution you currently work in, or in Scott's case, both your current role and your most recent one, how does your organization think about and work on the idea that for-profit investment can be a morally legitimate and economically effective way to promote community development? That's the overarching theme that I think we all share on this panel. How do your organization and the members of the organizations that you work with think about that? So just start by kind of describing a little bit of how you answer that question, and then we'll get into what you've learned and what you see as the cutting-edge issues in the future. So start with Cathy. Do you want to start?
Sure. I'm Cathy. Cathy Dolan from Opportunity Finance Network, and I apologize to all of those of you who actually know what a Cdfi is, because it means that you don't have enough fun in your life. No, not true. So I work in the Cdfi industry. I work for a Cdfi, but we also work on behalf of the industry as we are a network organization of other Cdfis across the country. And our mission is to deliver and enable capital access to low income, low wealth, and other disadvantaged communities and people. And we believe that capital is the key to opportunity. And that many folks who are in low income, low wealth, or other disadvantaged situations, that at least partly why they can't enter the economic mainstream is because they can't get access to responsible and affordable capital. Well, so you can see, given that that's our mission and that's what we're in the business of doing, why Antony's question is so important to us. Because if all we meant by capital was charity or philanthropy, we wouldn't get very far. Philanthropy and charity play a very important role in addressing the social ills of our society. But if you could attract investment capital to supplement philanthropy, you would have a lot more capital to actually address the needs of the society. Now, there's an important distinction, though, that we believe as we go forth in using investment capital as opposed to philanthropy that might be a little different than some of you who are at this conference, given that it's called social enterprise. We believe that while you can get returns on the capital, and you can actually get a return of your capital, you may not be able to get always market rate returns. And it's not just a risk return kind of thing. I'm not even talking about that. What I'm talking about is in the 30 years we've been in business and our members have been in business, we've realized that subsidy and charity plays an important part in solving the capital problems of our communities. So we believe in the use of smart subsidy that complements and supplements the market rate or the market provided capital that we rely on. So as financial intermediaries, because we're as a financial institution, we're a financial intermediary. We borrow money from banks, from foundations, from the federal government, and increasingly from corporations and individuals. And we turn $1 into $7 and use those $7 through leverage to make loans to small businesses and affordable housing and charter schools and the like. We have to pay back those that lend us money. Oh, Dan, what an entrance. We have to pay back those creditors, and we have to usually give them a rate of interest or a rate of return, but we don't pretend that we can give them market rate returns, or if they invest equity in us, we don't say we can double your money in 10 years or 3 years or 5 years. And it's simply because the work we do is hard work, and if it were easy, and if the market rate investors really could come into these communities and invest money and solve these problems, they would have done it already. And there has to be a different approach to using capital and even market rate capital in order for it to work for the investors and work for the communities.
Great. Thanks so much. So we'll get into the debate a little bit later about the nature of returns and what they should realistically be expected. Before we get into that, just wanted to turn to Jeannine. And so I think Cathy's outlined in general the work of the community development finance institutions that are associated with the Opportunity Finance Network membership, trying to get away from the acronyms. And you work specifically both in your current work with the Community Development Bankers Association. So I just want to talk a little bit about this subset within that community that is focused on the bankers, and also a little bit about your previous role in the Community Development Finance Fund in Washington and how the government thinks about this question of using investment as a complement to other tools.
Okay.
Thanks.
Right. Just to give you a little bit of a background, I'm really sitting here wearing two hats, and most of the time I do. I'm the CEO of a community development loan fund called Partners for the Common Good, and it's based in Washington, D.C., and we operate as a wholesale intermediary fund, primarily engaged in participation lending. And then I also am the senior policy advisor and CEO for a group called the Community Development Bankers Association, or CDBA. And we are the trade association for the CDFIs that just happen to be organized.
Sorry, that was an acronym.
Yeah, I know, but you already defined it. So,
okay.
Now it's open, we can now use it. Okay.
You guys got it right quickly.
Yeah,
so
that's right.
You only get one explanation.
That's the one slide we should have had up, sort of as the definition slide. So the CDBA is comprised of banks and thrifts that have a primary mission of promoting community development. So they are like other banks that you see, except for one really important difference, and that is that the majority of what they do, 60% or greater, is focused on low-income communities. And they may be urban communities, they may be rural communities. There are a little bit under 8,000 banks in the United States in operation right now, and only about 1% of them, or about 80 of them, have been certified as community development financial institutions. So it's very much a niche market sort of within the banking sector. But like the OFN's membership, which is mostly, it's diverse, but it's mostly comprised of non-depository loan funds. They share a common mission, which I think Cathy explained very eloquently in terms of, you know, having a belief that providing access to capital and fair financial services are one of the really keys to providing economic opportunity for people that are living in low-income communities, but also are another tool that you can use to make markets work. I think what happens in a lot of low-income communities is that the markets become dysfunctional for a whole lot of reasons in terms of, you know, loss of employment opportunities, lack of investment, et cetera, et cetera. And I think one of the roles that the Cdfi plays is actually trying to take that negative economic, you know, sort of spiral and turn it back around again and start to make some of the places that they're working in more vital places again. So I'm coming from both of those two roles, and you want me to talk about in terms of the banks, you said.
Yeah, and then later on we can maybe touch on some of the policy implications of this work as well.
Okay, all right, I'm going to pass the mic.
Great. So you mentioned, Jeannine, that these community development banks are really focused on fixing market failures, putting capital into communities where capital and some of the support can really help create the dynamics in which there can be economic growth. So I just want to talk to Dan. Dan works for Goldman Sachs. No one mistakes Goldman Sachs for being a place in which, okay, he just looked at me, I'll stop
Just
there.
start over.
Anyway,
Start over.
I think it was your boss who said that you do God's work. So talk about how...
Really?
I'll start over again. It's Friday afternoon. You came in late. I'm not going to...
That's fair.
So I get the question I ask is, you know, unlike the other two speakers who come from organizations that are explicitly focused on the social mission, who have a thesis around how do you put capital to work in communities in which the primary purpose is creating opportunity and transforming those communities. That is not the primary purpose of Goldman Sachs, and yet the Goldman Sachs Urban Group is putting a lot of capital to work in those communities. So what does your group think about the use of the for-profit investments, the opportunities you see, and how do you see that intersecting with the community development imperatives that you are also seeking to achieve in the places where you invest? Is that better?
That's a lot. I would say, as someone once said, I've been introduced many times, and that was certainly the most recent, is the best thing I could say about that. So I think the question was, we're at Goldman Sachs, we have a bank, we've been investing in community development projects. Actually, the group that I'm a part of has been investing, doing this kind of work since before the firm became a bank holding company, and how do we look at that? Mm-hmm. So I think were two phases, and I'll be brief about that. The first phase was really commenced in 2001, when the firm created the Urban Investment Group. And at that time, it was really, I think, the first ever investment bank to use on-balance sheet capital to do double bottom line investing. And the thesis was, you know, an emerging markets thesis. We were going to invest domestically in emerging markets with emerging developers, and it was both real estate and corporate. And that group, you know, was operating for 10 years, 8 years, et cetera, doing a great job, had a limited amount of balance sheet, but was really investing for impact and for return. And they were bringing the Goldman Sachs approach. Equity investment, mezzanine type debt, highly structured investments with a real return. They were really trying to complement, I think, more conventional financing sources, including CRA banks. And then 2008 arrived, and there were a couple things that happened. One of them was that Goldman Sachs became a bank holding company, and the bank folks looked around and said, my goodness, we have this thing called CRA now suddenly.
Sorry, we're an acronym-free zone.
Sure. Yeah. You need like a swear jar. You know,
I do.
You need a dollar.
I need a quarter.
We'll raise money for the school.
So CRA.
Yeah, Community Reinvestment Act, which I generally assume you have a sense of, but just very quickly, it's a regulation that says that if you're an insured depository, you have an obligation to reinvest back into your community. It's sized off the, roughly off the size of your institution. So the bank was formed, people looked around and said, who the heck knows anything about this? Okay, you people down the hall, the UIG folks. And so that team went from having, you know, a couple $100 million of balance sheet with about 6 people to having a significant multiple of that capital, and we now have about 22 people. So I think the long answer to that is we take the same approach now as we did before. We are private equity investors. We focused on real estate transactions. We're unusual in that regard because we're a wholesale chartered bank, so our peers, if you will, are Morgan Stanley, Deutsche Bank, Bank of New York, and they're not directly investing in projects at the retail level like a Chase or a Citi or a Bank of America. But we do investing, and we do it for the same reasons we did before, because it's got a high impact, but now there's a regulatory imperative around that, and I think it really just distills to what some people have called the 3 Rs. It's really rating, return, and reputation. And I can talk more about that, but I'll stop there.
Great, no, and we will we'll come back to you. So just wanted to finish the introductory part with Scott Budde, who in his current role is able to take this conversation and really talk about its implications not only within urban communities, but also in rural areas, in the work he's leading now around a new loan fund. But also talk a little bit about your role previously at one of the country's biggest pension funds. So this is not just a story about nonprofits and Community Reinvestment Act motivated bankers, but you led at TIAA-CREF a portfolio that included a few $100 million, I can't remember the final number, that was put into impact investments across a range of asset classes and a range of countries, including in the US. And so, again, talk about the motivation for that and how did that fit into the larger goal of one of the world's biggest asset managers.
Sure. Well, so this is, I spent up until February the last 18 years of my career, as Anthony mentioned, in the investment management arm of this large pension company, TIAA-CREF. All your professors and staff at Columbia would have TIAA-CREF as one of their pension options. And in fact, there are about 4 million people who use TIAA-CREF, and they are, most of them working as faculty and staff within higher ed and education-oriented nonprofits in the US. And the last 7 years of that part of my career was spent heading the firm's social investing strategies. And I think most importantly, getting the firm to take a much more proactive approach to social investing. It sort of had some involvement in different strategies, governance, screening, impact, and community investing, but getting it to be much more active, and then particularly on the community and impact investing front. So starting in 2005, 2006, we created a new department within the investment management area to focus on those activities. And just to get right to the issue of rationale, I think in TIAA-CREF's case, there's no regulatory requirement. TIAA-CREF is not governed by the CRA. And the number one reason for doing these types of investments was really client demand, because those 4 million people who use TIAA-CREF at 15,000 institutions around the country were far more involved and aware of environmental and social issues. And so we knew from surveying them and as you know from working with them, they're not shy, right? So they are constantly telling you what you think you should hear. So we knew from surveying them and them telling us that if we could go out and find investment opportunities that offered a combination of competitive returns and some positive social or environmental impact story, that was highly desirable to them and in keeping with the firm's general mission, which was retirement savings. So the rationale for TIAA-CREF was really quite simple and rested largely on that. In terms of my current work, you've heard a little bit about Cdfi options. One of us probably should have put up the chart of Cdfi types. Because there are different types. There are loan funds that you've heard a little bit about here. There are community development banks, so community development loan funds, community development banks, and there are community development credit unions. So just like Jeannine mentioned, one twist on banks would be for ones that are operating in underserved areas and low-income areas. These might turn into community development banks. The same is true for credit unions. So you can have credit unions working in underserved areas that would have that same designation. There are also venture funds. There are a couple of other types. The main ones are, though, loan funds, banks, and credit unions. And my current project is looking at extending the community development credit union model to serve underserved, really a more rural population that's focused on small-scale sustainable agriculture. So that would also be the first time of taking at least the community development credit union model really into the sort of sustainable ag model. So if you know Martin Eakes, the CEO of Self-Help and one of the great visionaries, you could think, think Martin Eakes meets slow money or something like that would be the goal of this of that model. And I should say credit unions have a little bit of a twist. They are typically very market oriented, and they are regulated because they are the deposits are guaranteed by the government, just like a bank. However, they are tax exempt nonprofit cooperatives. So that is a little bit of a different twist. That means starting them is maybe somewhere across between starting I don't know, an NGO and a bank. I mean, it's a very interesting twist. Though when they are up and running, they need to be very market-oriented structures. So I'll happily go into more detail on that model.
That's great. So this is, I hope that's a good background and gives you a sense of the diversity. I mean, you heard, Dan say that for him the motivation is, or at least his group is, partly regulatory, partly reputation, but also an emerging markets thesis that says there is money to be made in markets which are underserved and underdeveloped. Cathy, I think, had a strong point of view that that is true, but that we can't oversell the extent to which this can be done in truly impactful ways and in market rate. And I think we can get into that debate. But I think this has been a largely abstract conversation. And so one thing I wanted the panel to do is just briefly describe for us a deal or an institution you work with, let's say recently, that either is particularly exciting or you believe really exemplifies the power of this approach. So just spend, a minute and tell us a little bit of the details. Where did it happen? What was the sectors? What is the social impact it's going to create, and how did the capital flow in terms of the expected financial returns?
Okay. So, how many of you drink coffee or tea? Yeah, you're in school, of course you do. How many of you go across the street and purchase a Starbucks every once in a while? How many of you, in purchasing a Starbucks, also gave $5 and got a wristband?
If not, get out.
Thank you. So, about a year ago, OFN and Starbucks launched Create Jobs for USA. And it is a fund that is addressing the jobs crisis in the United States. Howard Schultz, CEO of Starbucks, recognized that, well, it's like Paul Farmer said today, that we had a jobs crisis in this country. And what he was frustrated by was the government gridlock, that government was not coming together and leading this country in a way that was bipartisan, and they weren't leading, they were just debating and arguing. So he went public and started talking about how Americans needed to step up and actually help Americans. And by Americans, he meant not only individuals, but corporations. And it was focused around job creation, and he thought small businesses are touted as being one of the primary engines of job creation. And small businesses are complaining, given the environment, that they can't get access to capital. So how can Starbucks use scale for good? And his senior management very quickly said, excuse me, Mr. Schultz, we're really good at selling coffee, but we're not very good at making loans to small businesses. So can we go out and find a partner to help us do this? And we had had an affiliation with some executives at Starbucks. They found OFN and partnered with us in Create Jobs for USA. And what it is, for those of you who really want the finance details as to how this works, is For every dollar donation, whether it comes because you purchase a wristband or you purchase the Indivisible CD that's about to go on sale at Starbucks, or you bought one of the mugs that says Indivisible, because a certain amount of proceeds go to the fund. Every dollar that goes into the fund comes to a fund that's managed by OFN. We pass it on in the form of equity to our network, our members. We have 200 members across the country. So we, in essence, capitalize our members with that dollar of donations. They take that dollar of equity and they leverage it. Why? Because they're financial institutions, and that's what financial institutions do. So they go to Dan and they say, Dan, I got $1 of equity. Can I borrow $6 of debt from you? And Dan says, of course you can. And they take that $7 and they lend to what we call community businesses. And that includes small businesses, entrepreneurial, startup types of businesses, but it also includes small businesses that may have 50 or 60 or 70 employees. But they also make loans to affordable housing developers, they make loans to charter school operators, they make loans to healthy food farms like Scott's, the kind of community that Scott's trying to address. Anyway, our members make loans to community businesses that then go out and create jobs. So that is an example of how corporations and individuals now have gotten into the act, if you will, and taken an initiative of their own to actually help solve a jobs crisis, using CDFIs as effective intermediaries.
Great. I think that's part of this panel is about evolution, where this movement's going. I think partly what you're hearing there is a community of community development finance institutions largely born out of and capitalized by Community Reinvestment Act motivated bankers who are now being able to tap into interest among corporations or retail investors in other cases. So the source of capital is starting to diversify, even if the nature of what these organizations do with that money is consistent with what they've built up in the past. Anyone else have a good example of an initiative or a deal?
I'll do it. I'll do a deal, I guess. This would be in my TI-CREF past, though my current project is, of course, brilliant, but would be a little too self-serving even for me to talk about. The deal was at TI-CREF. I started an investment program focused on microfinance, which now, of course, needs to be called financial inclusion. The largest holding was a private equity holding in ProCredit Holding, which is a German-based holding company of 21 microfinance and more along the lines of SME banks.
What's an SME?
Small, medium enterprise lending. So one step above microfinance, very small scale loans. And these banks were in far Eastern Europe and Central Asia, Latin America, and Africa. I think it's the only microfinance SME type institution that has achieved real scale. It's now over 5 billion euros in assets. It's got over 15,000 employees. So this is real scale. And they have adopted a holding company structure far before the rest of this microfinance and financial inclusion world came upon that as a desirable structure to facilitate growth. Many of them have now come to it, but they've come to it fairly late, and ProCredit had this quite early on, and it had lots of advantages for them. And that was an equity investment. It's probably only 5 years into at least a 10-year investment.
Great.
I will say it did, relative to other global financial institutions in the financial crisis, which is an extraordinarily low bar, it did really quite well.
Yeah, that's great. And I know ProCredit itself is not in the U.S., but that model of microfinance is now finding itself in various organizations that are serving communities, many of which the people in this panel are also investing in. Any other examples of specific deals?
I'd like to give one example. And when you use the word innovation, you say, give me an example of innovation in the CDFI world. The big problem you have is that the CDFI world is all about innovation. And it is all about lenders that are trying to find ways to serve markets that most traditional financial services organizations don't do. And so a lot of the innovations that you've seen that have now become more mainstream, lending to charter schools, sort of back 10 years ago, 12 years ago, nobody was doing that. CDFI started doing that and proved that it was a product that one could do, and now mainstream banks are doing it. One specific example I want to bring up is a CDFI bank that happens to operate in the Twin Cities, the Sunrise Community Banks. And they were largely working in an urban neighborhood that had been very hard hit by the foreclosure crisis. And they had, sort of large sections of the neighborhood that they were serving where there were vacant houses that were now, all over and, creating all kinds of other types of social problems with crime and just the deterioration of the properties and how that impacts all of the neighbors. And they developed a partnership with, it was the bank, it was a nonprofit loan fund that was in the Twin Cities area, and a housing counseling agency. And they were able to get possession of some of the foreclosed properties, and the bank made a loan to the loan fund because the bank had some regulatory constraints on why it couldn't do the type of product they wanted to do. Made a loan to a loan fund, which was and I'm going to use an acronym, but I'll explain it. It was a loan with 100% LTV, which means loan to value ratio, which means that the borrower did not have any equity in the property. But what they had done with these borrowers, they were all very carefully screened, and they had all gone through home ownership training program, financial literacy training programs. They were all low-income families, working poor families that came to occupy, and they've probably done just about 30 houses at this point, where these the new owners of the program has been going for about 3 or 4 years, and they've had no defaults on the property at all. And these are in neighborhoods where the income situation isn't always very stable. But by the bank, the loan fund, and the counseling agency working together, they were actually able to create a system that could help those borrowers be able to become homeowners in the first place, but also to help contribute to improving the strength of the neighborhood.
That's great.
Can I just really quickly? We had a deposit program that included deposits with Sunrise, just as a little tie-in.
Yeah. So just to kind of pick that out a little. So as part of Scott's money at TIAA CREF, he was sitting on assets that he was tasked with deploying across asset classes. So he's putting his cash. Yeah. So part of that is his cash allocation, rather than depositing his cash with State Street or one of the other big, money typical places you put cash. His group's mandate was put that cash into organizations who, by having it, can actually do something productive in the community. That money then sits in this bank in Minneapolis, which, with the support of Jeannine's group and others, is able to run a program that allows that cash to be put into buying up houses under the new mortgage program. So that's sort of how the whole thing fits together. I mean, we're making a joke about not having acronyms, but these do tend to be pretty complicated and interesting things to do. So Dan, any specific example?
I don't have any trouble being self-serving, so I'm going to talk about one of our deals. I do think, by the way, that this discussion about innovation and particular projects is great. However, it's a sort of a curse and opportunity of the community development industry because our stuff is so complicated and has so many acronyms that the real challenge, I think, for this industry is how to get beyond either somebody who's socially motivated or somebody who's has a regulatory imperative. And I think the conversation is how do you expand this industry and how do you attract other sources of capital? And to that degree, I think Cathy's example is a great one because it was one of the first times really that the profile of our industry and CDFIs got, magnified and escalated to Starbucks. It's not quite crowdsourcing, but it's something close to that. But it did really connect the need for capital with the individual. And I think that's a bit of a holy grail that I think our whole industry has looked for, is how to connect the retail investor, the socially motivated capital, those trillions and trillions of private assets that are out there looking to be invested into the kind of work that we do. That funnel is so tough and is so tight and is such a bridge too far that that's a big challenge for our industry. And I do think there's reasons for that to get to scale, to get to conventional investors. There's a lot of things you need that are really the antithesis of what community development looks like. But more broadly, I mean, I could talk about the transactions that we or other banks do, which involve investing in the low-income housing tax credit, investing in the new markets tax credit to finance a charter school or other types of community facilities. We're providing private equity and joint venture with private developers to, for instance, acquire foreclosed housing right now and rent them to low and moderate income families, even on a lease-to-own purchase program. And one of the last things we've done, which you've probably read about, is what people are calling our social, you knew that was coming, it was just a matter of time, and, our social impact loan. It is not a bond, it is a loan. But I will describe it specifically and then more generally as really a pay-for-performance model. And I think this is really a huge opportunity for the industry and for communities. So very simply stated, there's a terrible problem in jails with recidivism, with young adult males mostly, but also females, who go into the jail system, and literally it's a bit of a revolving door. Bad things happen, there aren't a lot of supports, there isn't really intervention, nor any concept of rehabilitation, and you know, folks come out and folks come back, and it's a significant cost on every level, as you might imagine. So we, in consultation with the City of New York and the Bloomberg Foundation, have created a structure where we will essentially be providing funds which, through some not-for-profit support, will be providing some interventions to populations in the jails. And if over time the amount of recidivism decreases, our loan is repaid. There's a backstop from Bloomberg from some percentage of it, but we are at risk to either lose a certain percentage of our loan or to gain up to a certain capped amount on our loan. And that is effectively, and you probably know more about it than I, it's a bit of a pay-for-performance model. We're in an environment now with local governments and municipal governments whose resources are quickly diminishing, and it will only get worse. Yet the need to provide services is outpacing where we've been before. I think you all know that. So why can't we come up with some financing models for them if we can pay for something to, it's almost like replacing a boiler, right? The weatherization example is the simplest example. If you've got an old boiler and it's in a crappy old building, then they're paying more than they should for that fuel, but they're paying it and they're keeping afloat. If you can pay for the new boiler and then lower the cost, then that cost savings is something you could use to repay the person who gave you the boiler. It's a bad analogy, but it's sort of apt. We're thinking that that is something that will expand, and we're looking to do that in other markets. And I think, you know, outside of the financing techniques that we're all using, this is a pretty innovative and fantastic new approach.
So just on that, if you're interested more to hear about social impact, I would call them derivatives, but they're called social impact bonds colloquially. They're not bonds. That's Dan's point, which I agree with. Payforsuccess.org is a website that both has very good introductions to this whole concept as well as deeper knowledge and information for people who are already familiar with it. Full disclosure, my organization runs payforsuccess.org. We don't get paid. We don't have any click ads. But it is, as Dan said, I think, and that's what I turn to the panel and frame this. So we talked about the success of this industry, the idea that you can use investments in all the various ways we've talked about, pretty complicated. That can be a legitimate and effective complement to philanthropy and government in supporting the goals we have in our communities. And yet our communities are really suffering. In New York City, poverty went up another percentage point. 21% of New Yorkers live in poverty. Around the country, we all know about the unemployment crisis. And as Dan just mentioned, our governments are actually in much worse shape than most of you know because of a set of factors that have made the last few years look less painful than they will be, regardless of who we put in office. It's going to be worse or it's going to be really worse, depending on who becomes president. I work for a 501c3. I don't have a political opinion. I'll just say that. But the reality for the next decade for all of us in our work is going to be... You do have a political opinion. I do have a political opinion, which I won't express. But I think the reality is that we are going to have to be even better at what we do. Because simply doing what we've done has made a huge difference in the communities. The people who are now living in homes they would have been kicked out of, the people who are going to be in prisons getting the support they need to be able to not go back, the farmers that Scott is working with who will be able to access loans. Well, that's great. And yet, things are getting really, really bad out there, and we're going to have less and less money from government to fund, ultimately, a lot of what we've been doing. So what are we as an industry going to do to be part of the answer to this question that says, how are we as a society going to, in the next decade, be able to secure a decent and just society despite these macroeconomic realities. Is what we're doing enough? Do we have to think in even more bold ways? We heard from Cathy that one thing we've got to do is figure out how to engage retail investors and the general public. Dan has talked about innovative ways to help governments invest in prevention when those investments can actually reduce government spending down the line. What else is going to need to be done, and what are we doing as a sector to step up and get it done?
Yeah. I had two things, one of which is low-hanging fruit because they aren't in the room. But the ones that are in the room, I think within large institutions, and Dan can speak for Goldman if he wants on this, I think one of the roles, one of my jobs at TIAA-CREF was also to constantly push the strategies that we had in a bit into the mainstream wherever we could. So that people, and that's why it was very important to me that our group sat within the investment management area and not within TIAA-CREF Light or TIAA-CREF something else or something like that. And pushing those strategies into the mainstream. I would say a good example of that was that TIAA-CREF, which does quite a bit of large-scale ag investing, now is a leader in having standards around how that ag investing should be done, and it works with the UN Principles for Responsible Investing on doing that. So that constantly pushing within mainstream organizations, which many of you may be working in mainstream organizations, these activities which maybe were this charter schools is a very good example because this was you're right, quite fringe, A
dozen years ago.
Yeah, and now is much more mainstream. And people who go into charter school investing or lending do need to be very mindful of impact because that's kind of the point. So I think that mainstreaming is one. And the second, and this is what should be low-hanging fruit, but as we all know is incredibly high-hanging fruit, is maximizing foundation impacts. So the foundation community, which has $600, $700, $800 billion of assets, the vast majority of them do nothing with the 95% that they're not giving away in a given year. Nothing. They're oblivious would be the nicest thing that you could say about some of those approaches. So
it's nicer than some of the things I've said about them.
It's nicer than most of the things I've said about them too. So having those, and I think that that has to change. How it changes, we're not sure, but that's got to change. I mean, because that is a pool of money that exists due to the good graces of the American taxpayer, and that should be working toward the public good. So the idea that you have foundations that are supporting Paul Farmer with one pocket and working at absolute cross purposes with another pocket is just crazy.
Yeah, so just quick numbers on that. There's about $600 billion in U.S. private foundations. That money is invested, almost all of it in mainstream investments, and heavily tax privileged. And in order to maintain the tax break on capital gains, what the endowment managers have to do, or the foundations, is show that they have contributed 5% each year to charitable purpose. Scott's point is that almost all of that 5% is currently donated to nonprofits. A very small percent of it also can be invested in investments that qualify toward the 5%. But you've got $600 billion that's invested in mainstream investments. You've got about $40 billion a year that foundations give away. And the point is, what are we doing with the $600 billion when it's not being given away? And there is increasingly movement around that, and there are some leading foundations who've said, actually, we should be taking our investments and putting them into investments that serve our social purpose. And if you're interested in that one, Global Impact Investing Network, the GIN.org, and the Mission Investors Exchange are two places to go where those people who are thinking about that concentrate. Just another point of reference, $300 billion is about total charitable giving in the US each year, of which about $40 billion is from foundations. So just wanted to put that out there. But Scott, so you're saying one of the things we need to do is mainstream these ideas in our capital markets, $100 trillion or so around the world. Also unlock some of that $600 billion. What are the other ideas of what it's going to take to make us more relevant to the questions of our time?
I think the remarks that both you and Scott made a moment ago underlie the issue about the importance of public policy in terms of promoting investments in communities, and also doing things that can actually at the same time discourage. I like your example where on one hand you do this and on the other hand government policy does something else. On one hand, you know, the Cdfi fund over the last several years has had some very nice levels of appropriated funds that have gone for making grants, loans, and other types of technical assistance to Cdfis all across the country, and have helped the Cdfi industry grow to almost 1,000 institutions from, you know, where it started off 15 years ago or so. You know, there were only a couple of hundred. So that's been a place where the federal government policy has really promoted the development of a whole network of institutions that can serve low-income communities. On the other hand, there are things that federal policy does that sometimes unintentionally discourage. You know, right now there is the federal banking regulators as part of implementing Basel III and some provisions of the Dodd-Frank Act, which, you know, are all intended, you know, sort of to, you know, make our financial system more secure and sort of less volatile. But, you know, some of the things that are in the current reg, which is not being implemented yet, but it's a proposed rule, are some changes for banks in terms of how they risk weight certain kinds of assets that require a bank to put aside more capital if they're going to be doing non-standard, sort of 30-year, you know, single-family mortgages. If anything where, you know, you either do a balloon loan or some type of an adjustable loan, or have the loan-to-value ratios, the LTVs, any lower than, you know, sort of 80%. Basically, it penalizes the bank, and, you know, the risk weights make it more expensive for them to do some of these types of lending that have been really important in terms of getting, you know, low-income people to be able to be homeowners, or, you know, to build charter schools, or, you know, to renovate multifamily housing developments. So, you know, that's a place where, again, it hasn't gone into effect and it's in a public comment period, but, you know, by making it more expensive for the banks to do that, it creates a set of disincentives. Now, they're trying to create incentives for banks not to engage in risky activity, but sometimes the pendulum can swing a little bit too far, and you can create a situation where some of the people you don't intend to hurt get hurt by policy.
I thought Dodd-Frank was a big kiss to Wall Street.
Yeah.
I must have misread that. I don't know. I'm glad somebody else will complain about capital treatment.
I have a good policy one. In 2012, the first new federal credit union was just approved in August, and I just talked to the guy. The application was 589 pages long. 589. So, you know, it started at 320 and it ended at 589. So I don't want to be too Paul Ryan about this, but, you know.
But I think what's really interesting, the overarching point is we've got a set of government regulations that are premised that the purpose of regulating the financial industry is to help protect the owners of capital from, you know, unnecessarily risk-taking behavior generally. We've got a new set of players here represented around this table who both want to manage risk and produce financial returns, but also want to produce social impact. And in the case of a lot of the community development finance institutions that you've heard, one of the ways in which they create social impact is to be more innovative in order to create structures that the regular markets can't solve. And the regulators have a hard time digesting that, given that their mindset is more linked to a set of imperatives that are not, you know, related to the idea of impact. And so I think what you see here is very typical. We see this all the time in impact investing, that people with a more complicated set of motives are engaging with a regulatory environment that doesn't know how to understand them because it comes from a more simple worldview. Anything else on other barriers? We heard about policy, we heard about engaging mainstream investors and the foundation angle.
There are a couple other things that I think are important to note. One is I mentioned a little bit about expanding the universe of investors, if you will. Those of us who have worked in the CRA world, the community reinvestment world, have long questioned why it's just banks that have this requirement, when the role of banks in the global financial institutions, global financial market has shrunk as a % of the total and been replaced by things like pension funds, things like hedge funds, money market funds, and investment, and yet banks are the only ones with this requirement to actually reinvest back into the communities. But it's not even just about the investment world. as our illustration with Starbucks showed, these should be affirmative responsibilities for all corporations and all citizens of the United States, because it's our communities. And so we believe, and part of our advocacy and part of our work is to try to carry that message across a lot of other platforms. And it's a bit of a heavy lift, but whoever said that what we do is easy. The second thing is we have to be smarter about this. I mentioned before that we believe in smart subsidy. We think subsidy is critical, or charity is critical, but you don't just throw money at a problem. You have to use it. You have to have incentives, and you have to have accountability, and then you have to lever it or structure it correctly. So Dan's example of the social impact bond is a really good example of the probably 2 or 3 dozen new ideas from a financial structuring standpoint, where you layer different levels of capital in order, from a financial engineering standpoint, in order to create a different kind of financial vehicle to make these things work. I think we need to do more of that. And then the last thing is awareness and facts, which I realize in today's environment that's a hard thing to get across. But Jeannine was talking about the regulators giving in one hand and taking away with the other hand. The safety and soundness regulators of the banking system are very concerned about safety and soundness, and they should be. We just went through a financial collapse where it became very evident we needed to maybe focus on that a little bit more. On the other hand, what they're doing is using outdated and uninformed screens to figure out what risk is. So sometimes they can't keep up because the innovation has been ahead of them, and derivatives and CDOs and all that kind of stuff they don't know how to do. But they also have misinformed views of what investments in low-income communities represent from a real risk standpoint. The Cdfis and OFN's network have a loss ratio over their 30-year history of less than 2%. During the Great Recession, it peaked at just under 4%. But over their lifetime, it's less than 2%. That doesn't sound like a risky investment to me. So why regulators would then force banks who invest in community development activities to hold a higher than proportional amount of capital for that is simply uninformed. So I think we have an education job we need to do to help address these problems.
I'll just quickly tag on. At the risk of freaking out the students, I'll give you 3 Ds and 1 E. If we're to get to impact.
Everyone at Columbia Business School is an A student.
There you go, exactly. Defend the record, demonstrate effectiveness, develop a secondary market, and one tactical thing is extend the new markets tax credit. So defend the record. Not only do we have the municipal government problem, we've got the fiscal cliff. And in the budget environment, suffice it to say that community development, the supports out there will be crushed. So we don't need a lot, to Cathy's point, and and we could do a lot with it, but frankly, we don't demonstrate effectiveness. This is not an industry that has a lot of data, a lot of longitudinal data, and it's very difficult for people to tell the story. Somehow, everybody sort of thinks that units equal impact, and that is really so far from the truth. The last D was develop the secondary market. If we're sitting here thinking about, wow, how do we get capital to these sources? I want you just to think about the single-family market, the GSEs, or frankly, even microcredit. And the dynamics of those markets, which attract a huge amount of capital and accomplish a goal, rely on some things, as I said before, that I think are difficult or contrary to what community development is all about. Scale and volume, standardization, some sort of enhancement, specialized originators who really just do that, performance data, and frankly, no subsidy. However, in community development, we've got small-sized deals, very fragmented originators all over the place doing lots of different types of things, high-touch models, highly complex structured models, not a lot of data, and a huge reliance on subsidy, and frankly, not-for-profits who want to kind of do everything from originating to servicing, which is why Cathy Dolan is going to get us the Cdfi bond and solve the world. Because we do need something that's analogous to a mortgage-backed security, and that is what OFN has been, and Jeannine and others have been taking a great leadership role in, is to create the Cdfi bond. We need a secondary market. If you build it, they will come. So I think Those are all kind of important things that we should
Did we get
talk
your E?
about. Extend the new markets tax
Okay.
credit. First, you have to reform it, and then you can
Great.
maybe extend it first and then reform it. That's
Yeah.
okay.
So that's the new market tax credit is a program that allows, won't get into the details, but that helps to put subsidy and equity like capital into projects that community finance institutions can both make money from and then also attract other lenders toward. A lot of the work we do involves incredible projects in housing, not housing, but in healthcare, education, and elsewhere that really does rely on the new markets tax credit and partners like Dan and other banks. So going to open up to questions, but just to sort of sum up that, you've heard about how the people in this panel and our peers are addressing housing issues. We're helping keep kids out of jails. We're helping create more healthy and effective and sustainable local food systems. You've heard about charter schools, improving educational outcomes. And as I said, healthcare is another area of growing interest among this community. And yet, clearly, what we have done is not yet we're not yet dealing alone with the problems that this country has, and we're going to have to do more. And we've heard some ideas of how to make that happen. So just wanted to take a few questions. And before I begin, I just want to say that I spoke earlier this week at a big conference in California, and someone came up to me afterwards and said, I'm so excited about this idea, but now I sat through your panel, and I'm just confused. So if any of you are feeling that way, I think, we don't want to patronize you. This is complicated, confusing stuff. But if you have questions that hopefully we can at least bring you back a little bit up from your confusion.
So we have a mic. I have to run downstairs and pitch my startup in 5 minutes. So you guys can just pass the mic back and forth.
So we'll take 3 questions together. And then
sitting right here.
Yeah.
You're in the wrong room.
good luck, Donnell. So take 3 questions and ask the panelists. If you have it directed toward a specific panelist, let us know. Otherwise, we'll take them together. That way we can get more of them in. Please say who you are, where you're from, and ask a question. Don't give us a speech.
Okay.
Thank you.
All right. Hi, my name is Alaya. I'm actually from Yale School of Management. We're visiting for the conference today, and thank you for great information. My question is a little bit basic, but what I wanted to ask the panel is, looking back to the financial crisis and looking at the purpose behind Community Reinvestment Act and the implementing regulation BP, which primarily focuses on investing in low and moderate income areas as well as the borrowers. Do you think that the CRA had played a role in inducing the recent financial crisis?
Great question. Over here.
Hi, my name is Ben Thomas from Seedco, and as an organization with a history of both small business assistance and lending and workforce development, job training, and job placement, I was really excited to hear Cathy talk about job creation. I think the dialogue, conversation around job creation in this country has been very impoverished. But I'm particularly concerned about the fact that I don't feel like we talk enough about job creation for people who need the jobs most, particularly people without high school degrees and without college degrees, and creating jobs for those people that will actually enable them to support their families. I think the story of the American economy over the last several decades is that if you don't have a college degree, the opportunities for you to live a decent life are way down. And so I'm curious to know if any of you are talking about or are aware of promising practices that really target job creation at those populations that need it most and at jobs that will enable them to support themselves above the poverty line.
Great. So just please show me your hands. In the back, I'd like to get a non-male. Thank you.
Yeah.
Hi, my name's Minden. I'm from NYU.
Sorry, what's your name?
Minden.
Thank you.
I'm from NYU Stern. You guys talked a little bit about how to measure return on impact investing and how difficult it is. I'm interested in hearing more about what measures are in place now and where you see it going.
Around non-financial?
Return.
Okay, so that's great. So we'll take those. So 3 questions. Are we the reason why Lehman went bankrupt? That's my version of Elias' question. The short answer is no, but I'll let the panel explain that. Ben from Seedco, I think a very good question. It's great that we're building housing, but this country really needs jobs, and not just jobs for everyone, but specifically for people who are increasingly trapped in what is no longer an American dream and is structural poverty. Great question. And then Minden's question, how do we think about measuring the social impact of what we do? So I'll leave that to the panel to take any one of them in any order.
Okay.
Maybe the non-bankers
Yeah.
take the CRA question.
I'm going to take the CRA question. And Elijah, I'm going to give you a research assignment here. Okay. There's a body of literature, a body of studies that has been done that has basically looked at the very question you asked, whether CRA loans, whether loans to low-income people were the cause of the financial crisis. First, there's a body of research that was done by the Federal Reserve Bank of San Francisco, looking at a portfolio of loans in California done by the banks that were in their jurisdiction. And that found that that banks subject to CRA were their loans were half as likely to end up in foreclosure as loans issued by independent, meaning non-regulated mortgage companies that are not covered by CRA. There was also a 2008 analysis by the Board of Governors of the Federal Reserve System that found that only 6% of all higher priced loans in 2006, which was the peak of subprime originations, were made by CRA-covered institutions or their affiliates to low-income borrowers or neighborhoods that were in their assessment area. And then finally, the University of North Carolina in 2010 did an analysis that found that mortgage borrowers obtaining loans through special lending programs, including CRA, to low-income purchasers were estimated to be 70% less likely to default on their loans than borrowers with subprime loans.
So there. So there.
So the fact that Jeannine showed up with all that data makes me think you've probably gotten that question before. So I'm not going to let you do a follow-up just because I want to make sure we get to the other ones, but I think the panels will be here afterwards if you have a minute. So I think that takes care of the CRA question. Thank you. Ben's question on job creation and Minden's on measuring social impact. Anyone have?
Yeah, let me take the social impact one in particular. So in our world, we differentiate between outputs, outcomes, and impact. And impact is the hardest, clearly, because impact speaks to, well, let me start at the outputs. And Jeannine, correct me, because I always get the outputs a little confused. But outputs are something like, how many loans do I make as a CDF? As a mission-based lender, how many loans do I make? That would be sort of an output, because operationally I'm in the business of making loans, so how many loans do I make? That's an output. Outcomes would be, based on my use of proceeds, what did I produce? What did my loans produce? Number of housing units, number of jobs created or retained, number of enrollees in the charter school I financed, so those are outcomes. And most people stop there, right? So I've got lots of statistics about our members. We've put out $30 billion of financing over our inception. We've produced hundreds of thousands of housing units and tens of thousands of jobs and blah, blah, blah. It's much more difficult than, though, to say, how did people's lives change as a result of those outcomes? And truthfully, we're working hard at it, but we don't have it. We don't really know how to measure impact. So what do we do as a shortcut to that? What we do is about 7 or 8 years ago at OFN, we birthed, it's no longer part of OFN, Opportunity Finance Network. Sorry, Antony, you've been slack on your...
Well, once they're defined once,
okay.
so
We created a rating agency because we are the loan funds that are part of our Cdfi membership and the industry are unregulated financial institutions. The deposit taking are regulated, either credit unions or banks, but the loan funds are not. And we realized that our performance is only as good as the next CDFI's performance, because as an industry, if one is performing poorly, it reflects badly on all of us. So we went about somewhat of a self-regulatory venture. And we created a rating agency. And when you get a CARS rating, which is CDFI Ratings Assessment System, CARS, you get a financial rating, not unlike a Moody's or an S&P, but you also get an impact rating. But in our impact rating is not really telling you XYZ CDFI, how many lives did you change. We're simply measuring, did you do what you said you were going to do? You have to have a mission to be a member of OFN, and then we rate you to determine whether what you're doing, whether your outputs and your outcomes are actually aligned with what you said your mission was. Now, we can argue, and I probably wouldn't put up much of an argument, that as to whether that's really impact measuring. It isn't really, but it's a beginning, and it's something, and it's a way of holding ourselves accountable for actually doing something with the money that people lend us and donate.
Great, thanks so much. And for those who are interested on the outputs measurement, there's an initiative out of the Global Impact Investing Network called IRIS. You can find that on the gin.org website, and there's a ratings agency that's been developed for measuring the social impact of impact investments. That's called GEARS, GIIRS.org. So we are running out of time. Wanted, I think, Dan to pick up Ben's question on job creation and whether it's not only happening but also being targeted effectively.
That may have been a softball, but I'm going to take it, Ben. So Cdfi is a borrower of Goldman Sachs in our 10,000 Small Businesses program. I am not going to brag a lot about it because it would take too long, but I would say a couple things. Number one, affordable housing creates jobs, and affordable housing is an enormous category that a lot of banks are financing, and I think, again, we don't often tell that story. It's a little overlooked, but it creates temporary construction jobs, permanent jobs around those units. It brings a neighborhood serving retail. So affordable housing does a great job. It has not always been easy to connect local residents, who may be the kind you're describing, to those jobs. There's union issues, there's lots of different issues, workforce readiness issues, and I think funding workforce effectiveness programs and those kind of connections are really crucial, and we're engaged with one of those with NYCHA right now to better do that with construction projects and the huge amounts of money that the city is dedicating to those projects. Number two, then there's economic development and small business lending, and that is really important. It's a lesser amount of what banks do for lots of reasons. It's harder, and I think small business loans are perceived to be more risky in lots of different ways, but we all need to be doing more of those. I would note that on the equity side, interestingly, private equity, not to promote Governor Romney again, but private equity in our space is really interesting. It's been in two buckets. One is small business investment companies licensed by the SBA, which basically say we'll just invest in small companies and we can invest in anything, and any bank, that fund can invest in any kind of company. And a bank investing in the SBIC gets CRA credit as of right, check the box, no look through to the underlying portfolio companies or to any impacts. Yet the community development venture capital industry, which really was supposed to be supported by some SBA funding, really did not succeed, or at least hasn't. I think it's trying for a comeback. But they were trying to invest to create jobs and to create good jobs, and I think there's probably a tale to tell there. But it's just interesting to put those two together on a comparison basis. Lastly, I would say we are now trying to work more closely with the city to support manufacturing and industrial buildings and spaces and small business incubators and things like that, and I think that will go a long way to address the kind of
Great, so we have 2 minutes, and I want to get you out on time. So I'm going to ask the panel, we don't have time for any more questions. What question do you wish you'd been asked? And either answer it yourself or ask it of another panelist, and do that in 30 seconds each, and then we'll get you guys out of here. And Jeannine, if you wanted to go first.
Okay. I have two innovations I want to note that are directly relevant to people sitting in this crowd here today. The first one, have your pens ready to write this down. I want you to write down policy map. Okay. If you haven't seen policy map, it is it was developed by a group called the Reinvestment Fund, which is a Cdfi based in Philadelphia that is a proud member of OFN. And basically, it's an online GIS mapping system that the next time you're in a class and you have to do a local market analysis, it has, I think something they said, 4,000 data points that look at median income, that look at poverty levels, that look at business statistics, that look at population statistics. And it's one of those, it can be used in many, many different ways, but one of the primary reasons it was developed was to help understand the dynamics of what was going in low-income communities and look at new opportunities. But as a student, it might even be free to students, or they have a very discounted rate for students. But you should just Google policy map, and you'll find it's a great system. And the second innovation, I'm going to follow Dan's advice. I'm going to be self-serving for one quick second. Partners for the Common Good. We have got a new innovation called Cap Nexus, and it's an online database that's a loan matching system, kind of like, say, eHarmony for community development loans and lenders to be able to meet up. And the reason why it's relevant to this crowd is because right now we are advertising for somebody for a business development position, business development and marketing. So if anybody's interested, or your friends that graduated last spring, please come up and give me your card.
Thank you.
I feel like I'm on, wait, don't tell me. Sorry. The question that I wanted somebody to ask me was, are CDFIs social enterprises? And the answer is yes. So even though we're intermediaries, and what we focus on obviously is getting capital into the hands of the end users who are actually, boot on the ground kind of thing, the investment business is a business too. So don't overlook, as you're focused on social enterprises, and particularly in the capital raising, that CDFIs are social enterprises too.
I think I maybe already asked it and sort of started to answer it, which was the question of what are foundations doing and what are their pros, cons, and limitations.
And I'll ask questions. I don't necessarily want to have the full answers, but what happens if tax reform goes through at any level, and what impact would that have on community reinvestment? And the second one would be, what happens if CRA is eliminated?
Well, that was a very uplifting way to end. Thank you, Dan. Thanks, the panel.